Hi guys and welcome to another episode of Rise High TV. We're coming to you live today for a special episode. I've got Adrian Cartland here from Cartland Law, who specialises in property, trust, tax law, and we are talking about land tax. Very exciting topic. But look, we're obviously wanting to discuss this because of what happened at the recent state budget in South Australia. Obviously, land tax was one of the big things that came out of it. And interestingly enough, the government tried to sweeten the deal by saying they were going to reduce land tax rate. But then on the other hand, they're talking about an aggregation model. And I feel like not many people really understand what that means or what it looks like. So I thought I'd bring Adrian here today to ask all of our questions about land tax and aggregation and what that is going to mean for property investors. So that's what we're going to be talking about today. Welcome, Adrian.
Thank you.
And I guess the reason, just to put some perspective around this, the Property Council came out after the state budget was released and said that a mum and dad investor with 3 residential investment properties valued at about $1.5 million, their land tax would go from $1,000 a year to potentially $20,000 a year. So this is obviously a really significant issue for every investor that has more than, say, 2 properties that we need to consider. So it is something that you should be tuning into today to listen to, or forward to any of your friends that have property that really need to get value out of today. So firstly, we might just start, Adrian, with, what is land tax and how is it currently calculated? Let's talk about the current model first, sure, and then let's talk about what changes we might expect to see with the aggregation model proposed.
Yeah, sure. So the way land tax is assessed is it's based on whoever the owner is, and the owner could be the legal or the beneficial owner. So it could be a trust or an individual. So you might, depending on where you've purchased it. And the rate of land tax is progressive, so under $350,000 it's nil, and then above 2.5 mil it's 3.7%. So 3.7% is the highest rate, and that is huge. When you're looking at someone now, it's 3.7% of the
value of the land.
And so the value of the land, so that's not including the improvements. So the value now for most properties.
So would that be like when you look at your council rates notice?
Well,
do they normally have the value of the land, the capital value? But that
yeah. So there's a value of the land plus the house. Now there's a little bit of contention in how that's calculated, because what happens is there isn't that many sales of vacant land around, but the sales of vacant land that do happen, that's what the valuer general uses to calculate what the 99% of land that's out there would be valued at without a house on. So it's a little bit weird. But just as a sort of rough estimate, the land value of something might be, say, 60% of an average residential property. Like now, if you have a shopping,
I guess that would also really fluctuate depending on what suburb it's in.
Depending on the suburb, depending on the age of the house. Like, if it's an old house, it might be 90%. If you've just built this brand new, 3-story mansion, it might be, 40% of the value.
Yeah.
Most of the value is in the swimming pool and the.
So I guess, given that we're talking about value of the land, is there anything that property investors or property owners can do? Like, if I wanted to have a look at what the assessable value of my land is, how would you go about doing that?
So you can challenge it.
But how do you find out initially, like, what it's actually valued at? Does that just appear?
You get it in your land tax assessment notices.
Yeah.
You can.
So you look at your land tax assessment notices, and there it shows the assessable value. If someone hasn't traditionally received land tax notices,
it should be in your council.
You'll see it in your council rates notices. Okay. And if you did want to challenge that, like, let's say you feel that the value that the valuer general's put on it is too high, how would you go about doing that?
You can ask for it to be revalued. So generally these things, you're going to have a hunch that it's valued my property at $500,000, and I really think that the land is worth 300. If you're trying to get a slight value change, it's going to be very difficult to pull that up. Obviously, you have the burden of proof of proving that the value is wrong. So challenging valuations is kind of a complex and difficult thing. It's not a fun task.
Okay,
So
but it is possible.
It is possible. You can challenge valuations. You can put to the Value General that they've made a mistake and get that challenged.
Okay, so currently, like you said, land tax is progressive and the rate of land tax increases for the more property that you own.
Yes.
And like you said, property can be owned in different structures like individual, trusts, and companies.
So a trust is generally the default method of holding property when you've got more than one or two. So you might say you only go home, like just starting from a typical a scenario. You're going to buy your first house in your own name because that's what you do, and it's going to be your principal place of residence. You're not going to pay land tax on the principal place of residence. It's going to be your main residence for capital gains tax. You're not going to pay capital gains tax. It's really simple. Then you go, oh, maybe let's do some, let's buy another couple of properties. Maybe you buy one in your spouse's name, or then you go, let's start buying them in a trust. And the reason why you're going to buy it in a trust is because you can get the 50% capital gains tax discount if you're owning in a trust. You get asset protection, which is really important. So generally, if you have the risk of bankruptcy, you're in a business, you're in a profession, then you could always personally go bankrupt. And if you own it in a trust, those assets are quarantined from your personal bankruptcy. So from just a risk management point of view, you should do that. You can also distribute out income, so you can choose which of your members of your family are on the lowest tax rates, and therefore distribute out to them. And so you. And
traditionally, from a land tax perspective, if you have owned property in a trust, it has been considered a new entity for the purpose of calculating which bracket of land tax you fall into.
Yeah, it's going to be a different taxpayer. So there has been some contention as to how different the trust has to be, and I've been having fights on this for 15 years, and what constitutes a separate trust. But what you would do, just as a land tax structuring 101, you're going to own it in a trust for capital gains tax and asset protection and income tax purposes, and then you might purchase 2 or 3 properties per trust. Because that way, you say, if you're buying an average residential property, it's going to be worth $200,000. It'll put in land value, and so a couple of those together, you're going to be paying a very small amount of land tax. You're going to be at the low end of the threshold. You might pay $1,000 land tax all up, or even nothing if you have one property per trust.
Okay, so that's obviously the rules that investors have been following up until this point.
Yeah.
Now with this aggregation model, let's talk through what the state government is proposing. Just before we get on to that, a shout out to Giselle, Twee, Sonia and Sarah. Thanks for tuning in, guys. If you do have any questions whilst we're live, feel free to type them in the comments below, and we will do our best to answer them as we progress. So just getting back to what the state government is looking to change about land tax.
Well, so they're looking to follow the New South Wales and Victoria models. Now they haven't actually.
So have they come out and said that?
They've said that that's what they're going to do. That they're going to introduce a rate of surcharge on properties held in trusts and in companies where there isn't a particular beneficial owner set out. Now we don't know exactly what that's going to look like because they've said we're going to do it. But what we can do is we can look at what's happened in New South Wales. So New South Wales was introduced in 1985. Victoria was 2005.
So they already have an aggregation model in those states?
Yeah, well, what they have is a special trusts rule, and what that is for any discretionary trust, for any modern unit trust, so a unit trust that's not a fixed trust, then you're going to have to pay a surcharge rate of tax. But that basically
a surcharge rate of land tax.
Of land tax, yeah. Okay. And so which basically.
And what sort of rate is that?
Well, typically it'll bring you up to the highest rate of land tax. So that is to say, it'll be as if you have a number of properties aggregated together.
Okay, I understand.
So for example, if you had a $500,000 property, you'll be paying as a total like 3.7%. As if you own 20 properties. So
that's the case if the trust doesn't have a specified beneficial. So my understanding of trust is that you do have to have specified beneficiaries. You do have to have people listed. Is that enough to,
No. Well, so
meet this rule, or?
well, the way the model works in New South Wales is that you must have a fixed entitlement. Now, a discretionary trust, the reason the asset protection works is because you don't have a fixed entitlement to it.
Right.
You could potentially be a beneficiary of it, but you might not be. And so.
So you're saying if it actually changes that you nominate that someone does have a fixed entitlement, then they could actually lose the asset protection that comes with that discretionary trust.
Yeah, and the problem is that moving from a discretionary trust to making it fixed is likely to trigger capital gains tax and potentially stamp duty as well.
So in New South Wales and Victoria, when they introduced this model, what did people have to do to their trust to make sure that they weren't attracting the highest level of land tax rate?
Well, in Victoria, what they did is they said, for discretionary trusts, you have the ability to nominate one person who's behind it, or a couple of people who are behind it.
So did that involve having to change the nature of the trust from discretionary to fixed?
No, but it sort of treated it for land tax purposes as if it was fixed.
Okay.
So that was a really nice way of doing it, and that would be great if they introduced it in that manner.
So basically, just to clarify that, people with trust had the ability to nominate a beneficiary per trust or per property, per trust, to say, okay, well, if you've got a family of 5 people, mum is for this trust, dad is for this trust, child 1 is for this trust, child 2 for that trust, child. So that, potentially that's how it works in Victoria.
That was a once-off in 2005 when they when they brought these rules in. So I'm hopeful that they would have a transitional provision like this, but we're not sure. They might not. So if there was if there was something that you could do to help influence these changes, like we will push it towards the Victorian model of having the ability to nominate when these changes come in.
I guess on the flip side, what actually is the New South Wales model? Because that's another model they're exploring.
Yeah, so in that way, there was no ability to nominate, and it's a case of it's either a fixed trust or it's not. And a fixed trust is not even a unit trust. A unit trust is not fixed enough. So it has to be absolutely entitled to the income, the capital, with no chance of moving the property away to someone else, and then you will count as not being a special trust.
It's a bit harsh, isn't it? Because I look at my situation, for example, and we have a trust with property in it that's for the benefit of our children. If we had to then specify one of them as a fixed one, then one of the reasons as a parent why you'd have a property in a trust for the benefit of your children is so that if they do get married later on and their marriage doesn't work out, then these properties are protected from their divorce settlement, for example. Whereas if I'm actually now having to be forced to nominate a specific child to be the fixed beneficiary of a trust, and that specific child does go through a marriage breakdown in the future, could that property then be entwined in that in that divorce settlement? There's implications long term, isn't
it's
there?
Going to totally destroy your asset protection. And it's going to destroy your succession planning. So because then if you said I'm going to just say you've got 5 trusts and you've got mum, dad, nonna, papa, and a child, and you say cool, well let's go one trust for each family member. It's as if they own it themselves now. And do you want to, for your succession planning, do you want your child to be having a property as if they own it now? And do you want each of your parents to be owning this? Now there are ways around it.
And that can impact people's Centrelink and their pensions and a whole range of different things. There's so many complexities to this problem that you just you hope that the politicians really think it through before they make the changes.
We already have the highest rate of land tax in the country, and who this is going to hurt? This is going to hurt people who have got 3 to 5 to 10 properties. That's what's going to have the biggest impact on. If you're developing 500 lots at once, or you own massive commercial properties, you're already paying 3.7% on the whole thing. So it's not really going to be a big impact.
It's a bit of a worry. We've had a few questions come through, so we might address those if we can. We had a question from Twee. Twee asked, will these changes affect investors with existing properties currently owned in a trust? Good question, Twee.
Thank you, Twee. Yeah, unfortunately it will. So if
so there's no grandfathering rules. This is going to impact everyone that has.
That's right. Everyone who owns property in a trust, which is most property owners who have investment properties, are going to have to consider it. Now, the best case, the lowest impact is say if you had one property in a trust. And they went through the Victorian model of enabling you to nominate a beneficiary. That's going to have the lowest impact because you just simply not nominated. But if they went through the New South Wales model and there's no ability to nominate, then even just on that small case, you're going to have to do something about it. And then from anywhere up, you own a couple of properties, it's going to have quite an impact on people.
Well, even that, what the Property Council came out and said, because we talked a lot about trust, but the Property Council actually thinks that a mum and dad who own 3 investment properties, they didn't specify whether that was trust or not, their land tax would go up from 1,000 to 20,000. And there's a situation where you've got a husband and wife, and the husband owns one property, the wife owns one property, and then together they own one property. Currently, under the current model, they're considered as 3 separate ownership structures. Mm-hmm. Are we also saying that as part of these aggregation rules, that those 3 properties would now be aggregated together by the fact that they're married? Or is that something that the government hasn't touched on?
They haven't said that. The announcement, and it was just an announcement, it said that they're going to be looking at companies and look through to their ultimate ownerships. They're going to look at unit trusts. They're going to look at discretionary trusts. And they're going to move away, but they did say they're going to move away from the ownership model of determining things. So we're not sure. What I think will happen in there is they will say, instead of this being a separate owner, they would say you own 50%. So in this case, they would say the husband, he has his one property, and then he owns 50% of the second property. So therefore, he has sort of that together, and then the wife has half. And
so you reckon that they might put the husband's half together with his investment property that he owns and then. Yeah, it's going to get messy. We did have another question come through from Angie. Will these changes apply to both commercial and residential properties? And I think Adam wanted to know the answer to that one too. So what are your thoughts on this?
Yes, they will.
So it applies to both commercial and resi?
Yes.
And to the same extent? Exactly the same?
We did have a glimmer of hope for commercial when they got rid of so stamp duty on commercial properties, because you'd be able to move it to a different entity and without stamp duty, and therefore go.
But you still have capital gains tax.
You do have to worry about capital gains tax, but that's a little bit easy. There's often more ways of dealing with capital gains tax than there is stamp duty. Stamp duty, you either pay for it, pay it, or you don't. But with capital gains tax, maybe you can get some discounts. Maybe you can, maybe if it's a commercial property, you can get the small business concessions because you're running it as a rental, and you can contribute it some to your soup, or you can, distribute it amongst a number of entities, or you've got a loss entity you can distribute to. So there's a lot of things you can do to deal with capital gains, but stamp duties, you either pay it or you're not.
So whether you've got commercial investment properties or residential investment properties, this is going to impact you regardless.
That's right.
A few more shout outs. We've got James, Emily, Richard and Kyle, I think it is. Yeah, thanks for joining us, guys. Welcome to the show. So we've talked about the New South Wales models. We've talked about Victorian models. We've talked about commercial property and residential property. So let's start providing some potential next steps. What should people be doing? I mean, I've got one question that got thrown to me through the week by a client was, could a trust, in anticipation of what's going to happen, could a trust distribute a property? Because trusts can obviously distribute properties to their beneficiaries without stamp duty and capital gains tax is my understanding. Is that correct?
That's right. Well, maybe without capital gains tax, but without stamp duty, yes.
Yeah, okay. Could trusts also distribute to related companies, or would that not help with the situation?
They can. I just want to say, I would suggest that nobody changes until we see what the legislation looks like, and then come in and have a discussion, because you're going to need to think about this carefully when you're changing. We're going to want to look at exactly what the legislation says. I do have some thoughts on that there will be some things that we can do, particularly if you've got a number of properties that approximately equals the number of family members you have. But you're going to need to consider not just land tax, but stamp duty. So sure, you can distribute out from a trust to a family trust to a beneficiary without paying stamp duty.
Does that include a company?
No.
Can a company be a beneficiary of a trust?
It can be a beneficiary of a trust, but you won't get the stamp duty exemption.
Right.
And so you'll have, and you generally don't want to own property in a company unless it's a commercial property. And also, it probably won't help from a land tax perspective.
Because they're grouping up the companies too.
You've got to group up the companies as well. So he's going to look through as to who the ultimate owner is. So you're going to pick out who the ultimate owner is. So you've got a couple of problems. Then you're going to have now maybe you can distribute it out, and there are ways of doing a whole bunch of things without different taxes. And so maybe you could get it into your company without stamp duty. It depends on what kind of property it is, depends on what the relationships are, depends on what's happened in the past. So I'm not saying it's a blanket no.
So you're suggesting not to rush into changes.
Not to rush into changes.
And to wait for the legislation. Do you have an idea as to what sort of the timing of the legislation would be?
I would say 3 to 6 months. So I'd say we're going to, in the second half of this year, in this financial year. So we're going to, we're looking between now and Christmas. We should expect it, because it's going to need to come in time from applying from 1st of July 2020. So however your property is owned as of 1 July or 30th of June 2020, that's how it's taxed. So if your trusts are going to change, you're going to need to work out what happens, and you're going to need to change it. Now we do have what we could do now is just sort of start some general planning, because let me give you an example of what you could do. So just say you've got a property in a couple of different trusts. You've got Whiteacre in Trust 1 and Blackacre in Trust 2, and you've got a husband and a wife. They've got a couple of parents and a couple of kids. You could say, so at the moment, Whiteacre and Blackacre are going to be aggregated together, whereas they wouldn't ordinarily. But what you could do is you could say, I'm going to distribute out Blackacre to my wife, because she's, the husband is a director in a company, and he's potentially at risk, and my wife is looks after the kids, and so it's unlikely she'd get sued, or vice versa. Could be the other way around. You've got to pick which spouse is at risk, or maybe you distribute it out to your parents who are. But you could have essentially one property per person. You could get one for the husband, one for the wife, one for Nonna, one for Papa. And if you've got a couple of old kids above 18, you could distribute to them. What about kids under 18? Well, they don't have legal capacity. So if you distribute it into their name, well, you're going to have to hold it on trust for them. And so you could give it to them beneficially, but they won't really get it until they're 18. So you could do it for land tax purposes, but it's probably not a good idea commercially, and they're going to be taxed at a higher rate of income tax. So if you're getting rent from it, they're going to be paying tax at the highest marginal tax rate. Okay. So it's probably no, except for deceased estates. So with deceased estates, in Victoria and New South Wales, they've given you 12 months to deal with property. So before it gets the rate of the surcharge rate of land tax. Now this now normally you have that's not a long time though. You get 2 years for capital gains tax to sort out.
12 months to sort out a deceased estate is actually not a long time when you think about how much, especially if there's a few, quite a few assets in the deceased estate that need dealing with. That's actually not a very long time.
Nope, not at all. I know there was some lobbying that was happening when Victoria introduced it, saying, we need more time. It didn't work.
So that was my other question, should we all be lobbying our politicians? Is there any way that we could change their mind about this aggregation rule or what they're proposing to do?
Yeah, so this is this has been billed in the budget as a technical amendment. And what happens with technical amendments is that they generally get bipartisan support. So when did we last see a front page news debate over tax laws update, miscellaneous amendment bill number 5 of 2019? No one knows except tax lawyers. No one cares.
Until they get their land tax bill, then they'll start caring.
Yeah, and that's fine. So this has been billed as a technical anti-avoidance amendment, but what happens is does actually hit the middle of the population, people who have got a couple of properties. This isn't going to hit your big developers that much. This isn't going to hit people more generally. This is going to hit the core base.
It's going to hit the mum and dads that are just. It's really interesting that Liberal brought this in because it's
going to hit their base. I mean, they're going to tank in the next election because I'd say in 18 months' time. So 1st of July 2020, there's going to be assessments made. They'll be issued in October. There's going to be a whole in 2020. That's when everyone's going to realize, oh my gosh, I've got my land tax bill has gone from $1,000 to $20,000.
Yeah.
I'm just a pensioner who's built up a couple of properties from hard working over 40 years. Why has the government done this to me? And then they're gonna have to sell. I've seen people who have had land tax bills that are more than their rent. I see this again and again. People come and say, Adrian, what
that's
we do
ridiculous, isn't it?
Yeah, and with 3.7%, when you're looking at rental return rates, it's not that much different.
And it's not, and you've got all the expenses that go with it, like the loan and the to actually hold the property. So
yeah,
if you're actually paying 3.7% plus you've got a loan over the investment property, it's almost not worth holding it.
Correct. I mean, so this could lead to a.
But there is some silver lining because they did say they're going to reduce the rate down. Is it to 2.7? Yeah. Which is still. It's one of those high, but it's a little bit lower.
Sure that they're promising that, but they're going to. That they're going to hit a lot of people who weren't paying land tax at the moment. They're dropping the top rate down. Do you know who that helps? People who have 100 lots all in one entity. So it's going to actually so what they're doing is they're hitting your
mum and dads with your 3 to 5 investment properties.
That's right, and at the expense of your massive developers.
So what should we be doing? We should all be getting out there, writing to our local politicians.
Yeah,
telling them.
So practically, things that are technical amendments.
It's pretty scary, really.
So maybe it's the case that the Liberal Party wasn't really aware of this, because if it's a technical amendment, what happens is it'll come from revenue. And so the revenue authorities will say, look, this is just an anti-avoidance thing. There's a whole bunch of people doing nasty avoidance with their trusts, and it'll be billed like that. And so, what the politicians get is they're like, oh, well, we got to stop anti-avoidance. We got to stop people avoiding their tax. Everyone's going to be on board with that. Not really realizing that what this is actually going to hit is mum and dad with 3 to 5 properties at the expense of the big developers.
Yeah, that's So contact your local state politician and tell them how you feel about it if you have a problem with it, because it is going to be something that impacts a lot of people.
Yeah.
I think we've covered a lot of ground today. Is there anything else that you think people need to know about this topic, or? Just
remember that when you're doing this, this is not just about land tax. This is one of many taxes you're going to consider, and playing with trust deeds is something you should consider very carefully. That is to say, there are a lot of ways you can accidentally screw things up. So now I don't mind because, but I'm just saying because I get a lot more money if you screw things up.
You're going to be very busy next year. That's what I'm hearing, Adrian. Because by the time the legislation comes out, you're going to have your work set out for you, I reckon.
And that's right. And it's not just a case of just working out how to structure things for land tax. You're going to, because as soon as you move properties, you're going to think of capital gains tax, income tax, succession planning, asset protection. There are other trust structures that we can put into place that will be fixed but will have asset protection, or that potentially, and there are ways that we can move properties around. But each of these is going to take a lot of thinking.
Yeah. So I think that's some really good advice from you today, and I think the key is that we do have time before changes are made. So what you can do now is you can reach out to your local politician and let them know your concerns. But also you can start thinking about your own property portfolio. And if it is something that you're concerned about, definitely I would encourage you to speak to your Rise High mortgage broker and reach out to us and tell us what your concerns are in relation to your property portfolio. And if you want to get in touch with Adrian, we can make that happen for you as well, just so that you can start being proactive, so that you're not on the back foot when the legislation does change, if it does, which it looks at this stage that it's very likely to change.
And any change that you do will most likely involve having to get new finance, because it's going to be transfer from a trust to yourself.
So the legal and the finance side have to sort of work hand in hand to make it all work. So, we can work through that with you and work out what the options are from a finance perspective, and then get the lawyer involved to actually work out strategically what needs to be done from a legal perspective. But definitely we want to help you through these changes. So thanks for tuning in, and hope you found this useful and informative. Please feel free to share it with your friends or anyone else that you know that's got some investment properties in South Australia. It's important to spread the word and get out there and lobby to your local politicians to let them know your concerns, and definitely get in touch with your Rise High mortgage broker to talk about your portfolio and how it might impact you. And if you want to get in touch with Adrian, let us know and we'll make that happen for you too. So thanks so much for tuning in. Thanks for coming, Adrian.
Thanks.
Really appreciate having you. And we'll speak to you soon. Bye.